Hello, welcome to SilverOak's quarterly webinar. My name is Shannon King, and with me is Jonathan Charlo. As usual, Jonathan, we're here today for our quarterly webinar, which typically lasts 45 minutes to 60 minutes. Just to let everybody know, we're going to try and err on the short side this quarter to hopefully get through the materials within a 45-minute or so time frame. If there are any questions that you have throughout the webinar, please feel free to contact your SilverOak advisor after the session. If you're not currently working with an advisor, feel free to contact me directly at 952-896-5701. And as usual, I want to thank Jonathan and John and the rest of the SilverOak team who are all involved in making this webinar possible. For compliance purposes, I need to note that we will be discussing overall markets and the overall economy during today's webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We will also not be discussing specific SilverOak portfolio performance, as each of our client portfolios are customized. Nonetheless, all clients should have received their customized quarterly performance reports, and many clients we've already probably reached out to and discussed those with. Nonetheless, if you have any specific questions regarding those reports, please feel free to contact your SilverOak advisor if they haven't contacted you already. And lastly, as usual, past performance is no guarantee of future success. So, Jonathan, let's look at today's agenda. And we have it set up similar to prior webinars, where we'll start with economic data, transition into a discussion on markets. Then we'll talk about SilverOak's outlook moving forward. We'll go through some of the updates that are happening here at SilverOak and maybe some important reminders that we want clients and others attending today's webinar to be aware of. And of course, again, if you have questions, reach out to your SilverOak advisor. That includes if you have recommendations on future topics. We encourage everybody to send in their recommended topics that they would like to discuss in the next webinar, and we're happy to try and accommodate those. So Jonathan, here we say from an economy point of view that growth moderated as expected during the first quarter.
Absolutely correct. Although with the GDP print that came out today, which was a little bit stronger than expected, this might be a little bit dated, but we'll go through that in greater detail when we go through the GDP, but there were some one-time factors. What we saw this quarter was, as expected, growth moderated from high levels in the second half of last year, but there was a lot of fear in January and February, and what we've seen recently is that the numbers have actually firmed a little bit, but still moderating off of very high levels last year. The other factor we should just mention is that in our last webinar, we were in the midst of a government shutdown. Even though it's ended, there are still some data points that haven't quite caught up, so we'll go through those in each slide.
All right. So getting into the details, we have leading economic indicators, and you show here that they've ticked up a little.
Yeah, they increased by 0.4% in March, and it now stands at almost 112. We saw some positive contributions from unemployment insurance, consumer expectations for business conditions, and really the financial markets. The issue, though, is the 6-month period that's starting to slow, and you can see that on the right side. But we did actually tick up just a bit. 8 of the 10 indicators were positive. The one caveat is that building permits, that data is not yet available for March, and so the Conference Board did have to impute that number in the LEI release.
Sure. Manufacturing as well is starting to stabilize?
Yeah, so we went from fairly high levels last fall and declined, and we've been kind of going up and down. But the March number did increase slightly. It was up 1.1% and now stands at 55.3%. We are now in the 199th consecutive month of overall economic growth. The gains were in new orders and employment. And 16 of the 18 manufacturing industries did see growth in the quarter. While we're below the highs of last year, I will point out this still does point to strong growth. Now, outside the US, though, PMI is a little bit more mixed. Japan came out recently and came in slightly below 50. The Euro area also slipped in March and is now approaching potentially contractionary levels. So we'll want to watch that. The positive side, though, is that China, Korea, and Taiwan, so the Northeast Asian area, actually ticked up in March. And so that could be a positive issue for manufacturing and could help Europe later this year. Consumer sentiment just came out this morning, and we basically kind of seen a sideways shuffle this year, although last fall it kind of came down in the fourth quarter with the market. So we did see it actually recover in the February area and then came down a little bit last month. I will point out, though, that it's still at a very strong level, and in fact, it's been very stable within this range, and in fact, has been between 95 and 99 for 21 of the last 28 months. It really wasn't since the late 90s in the Clinton expansion that we saw levels with this type of number. The other side, though, is that the Consumer Board, Conference Board Consumer Confidence Index was down last month, so we have to kind of put those two together. At the end of the day, though, we're still at very good levels, even though it's been kind of going up and down.
And this is so important because, as we'll see later, consumer spending drives 2/3 of GDP. So making sure that consumers are positive with regards to where things are headed, that's an important driver of spending. If they aren't confident, they're not going to be out spending, which means GDP is probably going to drop. With consumer sentiment remaining positive, that's a good driver then for spending, which would then lead to better GDP numbers.
What's interesting when we look at the strong numbers coming out today is that when they ask consumers about longer term growth expectations and their spending expectations, is that 60% felt over the next 5 years that their condition would be better than it is today. That's actually the highest number that they've ever recorded, but caution is that they only asked this question sporadically in the 1970s and 80s. So the history might not be perfect.
Sure. And small business confidence, another important driver, also ticked up.
Yeah, so it declined from a very, very high level last fall, and it did actually tick up a little bit last month. The issue that we've seen, and we've talked about this in prior webinars, is a few years ago, the corporate side, the public companies were doing very well, but we didn't see small businesses kind of in that same boat. That's kind of changed, and what we're seeing in the employment numbers is that it's the small businesses who are hiring. So their confidence has picked up, they're hiring. The issue for them, and their number one concern still is finding people with the right experience, education to fill their openings.
Sure. And of course, a big driver of the markets, and again, we're right now talking more on the economy, but a big driver of the markets is around earnings. And here we're seeing that earnings are set to moderate. We're not saying that we're getting into an earnings recession, like there had been some discussion about maybe a year or so ago, but moderating.
So fourth quarter earnings have already been reported. It was a good quarter, but not as high of a growth as we saw in the previous 3 quarters. Expectations for 2019 are for mid to upper single-digit earnings growth, but that's far below what we saw in the second and third quarter last year, where earnings growth on a year-over-year basis was up 25%. I had kind of talked about the small businesses and what was going on in the job market. We're continuing to see strong job numbers. Total non-farm payrolls came out for March. They were up 196,000, and the unemployment rate was unchanged at 3.8%. We did see a relatively low February, so this was nice to see this sort of rebound. But again, we're late in an economic cycle. Unemployment is relatively low, and so it is going to be
relatively
hard.
Low.
Well, yeah.
Very low.
Very low when you consider you have a frictional amount of people that are moving around. And so, again, small businesses are really beating down doors to find people. So this is really a surprisingly strong print this late in the cycle. This is really the number that is a bit surprising, and this was just announced this morning. So Q1 GDP was reported. It was up 3.2%. This is the first advanced estimate, so there are two more reports coming out for the first quarter over the next couple months, so this could change. This was an acceleration, and it was higher than people expected. So interestingly, when we looked in early March at what Q1 GDP could be, the Atlanta Fed tracks numbers that come out and give you kind of a reading of where GDP is. And at that point, it was up 0.3%. So again, recent numbers have really increased. This is a good number, admittedly, but when you look below the surface, exports added about 1%. And so last month, we did see more imports than exports, and the thought was that had to do with people front-running potential tariffs. Without the tariffs kicking in, we didn't see imports ticking up this month. We saw actually exports. So that was a bit more of a potential one-time factor. The other potential one-time factor was we did see inventories build. So interestingly from this report, and Shannon and I talked about this morning, was that the 10-year Treasury bond yield actually fell a little bit. And so that is a little bit surprising when you see such a strong number. What's going on is below the surface, the business and consumer spending were a little bit less, and certainly less than they were in the fourth quarter last year. And so there's a little bit of concern there. But the other side of that is that core inflation only came in at 1.3%. And so that really keeps the Federal Reserve kind of on the sidelines still.
So if we put it all together and look at current economic factors in the scorecard that we discuss each quarter, we have a positive column as usual, a neutral column, and a negative column. Did any of these items change columns from last quarter?
We did not have any changes in the columns. We did have a few arrow changes, and I'll kind of go through that as we go through. We have housing with a negative arrow. That had a negative last year. We continue to see weakness in residential spending. It's now down 5 quarters in a row. The only thing I'll point out, and we'll show this later, is that mortgage rates have come down, and so that should be a positive factor. So we'll want to watch that.
So just to be clear, housing still considered a positive factor overall. We just had the arrow over the last quarter or two indicating that that one might shift from positive to neutral if conditions continued. But to your point, with interest rates lower, we might not have to make that shift from positive to neutral.
Correct.
The next one is, I think, employment.
Yes, so employment, we have a positive arrow. And again, that is because of the relative strength that we're seeing, especially off of last month's number. That was a number that actually was up in the prior webinar. One that had changed a little in the sense that we don't have an arrow is consumer confidence. We had a negative arrow last webinar, and that was because of the fall in confidence as a result of the market decline in the fourth quarter. And then here we have the corporate sector. This is actually a new arrow down, and this is just reflecting that slowing in that growth in corporate earnings this year. Again, not a recession from an earnings standpoint, just a slowing growth. Within the neutral category, we have interest rates as a positive, and that's just a reflection of the long-term rates coming down a bit, as well as the Federal Reserve now being on the sidelines.
So like we said last quarter, because I think we had a positive arrow there as well, the arrow pointing up doesn't mean interest rates have risen. It means actually rates have gone down, which is positive from an overall rates perspective.
Absolutely. Now, we don't have any other arrows in the neutral column, but I'll just kind of address this. Commodity prices, last webinar, we had a positive arrow. It's now without an arrow because we've actually seen commodity prices recover. US politics, we had kind of as a negative arrow. Nothing really bad happened since the last webinar. Obviously, we're entering a time where politics will be a bit more heightened, so we'll want to watch that. And then when we look at other issues, we had global growth and China as a negative. Now, interestingly, global growth has slowed, but we're now starting to see China potentially picking up. So numbers last month in China actually improved, and they put a lot of stimulative measures in place. Now that could be a positive driver for global growth going forward. We didn't put positive arrows because this is really 1 month of data. It's not necessarily a trend. Now the reason we didn't put a positive arrow on global growth is we did see manufacturing data from Germany last month actually weaken, and we mentioned that in the PMI section globally. So no changes, but some underlying issues with both indicators. And then on the negative side, we kind of know what these are. The Eurozone, it's the weakness, it's Brexit still out there. We have the tariff situation. Now, the Chinese and the Americans are going to get together and talk further, so that we might get an agreement, but we still have that in the negative side.
So that got into a little bit of the weeds. I'm sure some participants appreciate those details, while others maybe want more of a big picture summary. So here we're transitioning to the market dashboard, which really steps back and just looks at some of those details from that big picture perspective. And what we're seeing here is by column, each quarter looking back from starting at third quarter 2015. Our market dashboard is actually broken out in 4 major categories, starting at the top left with the economy, going into the credit markets, valuations, and market sentiment. Most everybody probably on today's webinar are familiar with this since we talk about it each quarter. At the very bottom, we have the composite, which is kind of the total. If the box is red, that means it's probably negative. If it's gray, it's neutral. Green means positive. So we can see as we look at the first quarter of 2019, economic data came in kind of in summary based on Jonathan's details that he just went through. It came in green, so more positive than not. Credit markets were more neutral. Valuations, more neutral. Market sentiment, neutral. And overall composite, neutral. As we look into the second quarter, and these are all projections. So as we look at what's going to happen next quarter, we actually have the economic data transitioning to more neutral. We have credit markets transitioning to more positive. We have the market sentiment also transitioning to more positive, yet the total composite at the very bottom still staying in that neutral category. So overall, things are fine. We don't yet see a recession on the horizon. which we'll touch on a little bit later. But we are seeing a few shifts kind of in particular categories here and there. I actually went back to the October 22nd projections to say in October, what were we projecting first quarter and second quarter to look like? And there were some differences. Pretty much across the board, the first quarter and second quarter data was projected to be neutral across the board with the exception of market sentiment. We thought that would be more negative. It's actually transitioned to more neutral to positive. So, what we thought might happen in October when we were looking out into the first and second quarter, for the most part, is online with the exception of market sentiment, and that's actually bounced back a little bit more than we anticipated. So just again, big picture overview for everybody that likes kind of that 30,000 level snapshot. If we look at the market dashboard composite number, and this is very important, this composite number has a threshold. We have the current composite at 3.51. The 6-month trailing composite right now is 3.30, and you can see those over in that right circle. Last time we looked at this though, the current composite had fallen below an important threshold. And that's the first circle that you see, the one at the low part of the chart. We were getting mixed signals last quarter. And you'll remember if you attended the webinar that we talked about this. The 6-month trailing composite was still above the threshold. The current composite had fallen below the threshold. And what I mean by threshold is a threshold for each of them where once it falls below, that's kind of a negative sentiment looking forward in the stock market. So last quarter, we had mixed signals. One was below the threshold, one was above. Wasn't really certain what direction the market was going to be moving. Both of them now are above that threshold, which is comforting, is it not?
Absolutely. So we're going to want to watch the market sentiment this year. Now, I do think that consumer sentiment does play a bit into that. And I think the other big factor we're going to want to watch is earnings.
Right.
And we're in an earnings season where we've had generally pretty good earnings, but we've had a few disappointments. We've seen, Intel, for example, today disappointed and the stock is down. So I think that will play a part in that market.
And we've had a couple other blue chips in the last day or two come out with disappointing earnings and frankly disappointing forward guidance as well. So I guess at the end of the day, as I'm looking at the data and frankly listening to what you've said so far, both at the big picture and getting into the weeds of the detail, it seems to be mostly positive, or at least kind of in that neutral to positive range, but some mixed signals. And that is pretty typical in this late stage cycle where you're starting to see some mixed signals as to whether things are moving kind of on the more positive or maybe on the more negative side. So that is all in reference to the economy. That is completely separate from what's happened in the markets. And frankly, so far this year, the markets across the board have had a very, very strong recovery. And we'll see that in the data here as we look at Q1 performance numbers. Across the board, positive performance. US large cap up anywhere from 13 to 16+%. International even up 9 to 10% or more. That is a big contrast, as everybody probably remembers, to the fourth quarter of last year, where we saw across the board negative numbers and most double-digit negative. So economic data we discussed was neutral to positive. The market so far this year, strongly positive off a very, very weak fourth quarter. As we look at the other parts of the markets, so bonds actually did well this year, or at least thus far this year, even with stocks being so strong. In the fourth quarter, as you look back, bonds were pretty much the only thing that protected on the downside, while all these other categories, along with the equities that we saw on the prior page, were all negative. So again, equity markets did quite well this quarter. You can see that here in this chart as well. Of course, growth continuing to outperform value, both doing very, very well. Growth just doing better. And as we look back over the year, that's been pretty much the trend. Now, what is driving a lot of that growth performance? We can see that here through the sectors.
So if we look at Q1 sector performance, if we look at the top half of the page, which are really kind of more of the value industries, you'll see that energy and real estate had returns that are above the S&P 500. Energy is a fairly large segment within value, real estate a little less so. The issue were the biggest sectors. So when you look at financials as an example, that was below the S&P, and so that led to kind of value underperforming growth. When we look on the bottom side at the growth industries, you're going to see technology and consumer discretionary had very, very high returns. Those are big components within growth. So if you think this quarter, while Amazon was down a lot in the fourth quarter, it's up a lot this quarter. That's kind of the driver. And then on top of that, industrials had a nice rebound this quarter. And I think some of that is over the anticipation that the tariff issues will be resolved. Now, when we look at the year, it's a fairly similar story. You know, here, though, on the value side for the year, financials are actually down. Energy is up a little bit. Materials are down. And then when you look at the growth sectors, you're going to see technology, consumer, discretionary, and healthcare all beating the S&P.
So as we look at this, again, stepping back big picture, growth has been outperforming for quite a while. And here what we're showing is the 10-year relative total return of the growth market versus the value market. So if we look at the middle line, I don't know, it's that red or orange, I'm colorblind, so I can't tell for sure, but that middle line going across, that's kind of break even. If the blue line is above that, that means growth is outperforming. If the blue line is below that middle line, that is a market where value is outperforming. So obviously, looking back, growth has more recently been outperforming pretty handily, but it is coming off of its highs, and we're seeing that in the circle. International.
So when we look at returns, here we're looking at 1 year. You're going to see that Germany on the far right is very negative. Again, I mentioned that manufacturing numbers from Germany have been weaker, but you're going to see negative returns across the board. So on the left, kind of more of the riskier assets, emerging market countries, China, Latin America, negative, not quite as much as Germany. If we look at the quarter, you're going to see that China had a nice rebound. And in general, when we look at the left side of the chart, you see BRIC countries are also having high returns. A bit of this is just that we've seen a general improvement in Asia that we highlighted, whereas in Western Europe, we've seen some weaker numbers. We've highlighted this in the past, but here we're looking at the gap between different sectors. So the blue line is the S&P 500. The orangish line is US bonds, and then the greenish line is global bonds, and then finally the yellow line would be international stocks. And the arrow that I'm showing is that performance gap between international and the US markets with the S&P 500. That was fairly in line until kind of that 2012 area, and then we saw this gap really expand. Now, we don't know when international will necessarily start to close that gap, but as we mentioned, emerging markets are starting to look better, and the US has definitely benefited from a better economy and a more aggressive Federal Reserve. But these trends won't continue forever. Here we're just showing an update. We've shown this in prior webinars on what's going on with the US dollar. It's been in an uptrend really since last spring, but still within the context of its new trading range.
All right, so we've talked about equity performance, both US and within US, large cap, small cap, growth value. We talked about the international. What about bond performance?
So bond performance has been strong. Here we're looking at the last 1 year. A little bit hard to see any variance because certainly Treasury bonds on the right have been very strong, and equally so on the left with emerging markets and high yield. When we look at the quarter returns, though, you're going to see that things on the left side are much stronger. This really has to do with the Federal Reserve being on hold, but again, this viewpoint that things in Europe are getting a little bit better. And so that's definitely helped risk assets, so to speak. Now here on the next slide, we wanted to give you an update on what's going on with yields worldwide. The last time we really went over this was in July of 2017. What you're going to notice on the left is that Switzerland and Japan actually have negative yields. Germany is flat, France is up a little bit, and then the UK. This has to do with what's going on in Western Europe and the fact that Japanese manufacturing slipped again in the last quarter. The US is at 1.5%, 2.5%, and then we're seeing China, India, Russia, and Brazil. And again, when we're looking at the right, these are countries that either have a bit higher growth, or we're looking at riskier and potentially more volatile growth. Therefore, yields have to be higher to entice investors to want to own those bonds. But generally speaking, we're seeing lower yields in the developed world, especially in Europe.
Sure. And of course, speaking of lower yields, here we have mortgage rates, which we had touched on earlier. This could be a bright spot in the housing markets because we did start seeing kind of peak rates in late 2018, but those have come down significantly.
So we haven't yet seen it in the housing numbers, but with lower rates, we should see some pickup activity in refinancing. Certainly now that it's spring, knock on wood, we're now kind of in season. And so we'll have to see how that affects transactions.
All right, and the last slide in this section of the webinar, we just point out the increased volatility that we saw late last year with the pullback in the equity markets, but that volatility has really subsided now that we're in the first quarter and we had such strong performance on the positive side.
Yeah, so it's declined and is now at about 12% on that line. We don't think we're going to go back to under 10 like we saw in 2017, but unless we see some major changes in the numbers, we also don't expect it to spike like it did last year.
So after having talked about the economy and after having gone through all of the market data we just discussed, let's touch on SilverOak's outlook. So I think it would be hard, Jonathan, to argue that we're not in the late cycle of an economic kind of phase that we go through. But near term, recession risks still remain relatively low. And that's despite recent but short-lived inversions in the yield curve, which we're going to touch on here in, I think, the next slide or two. Why are we still not expecting to see a recession, at least not in the very, very near future? Well, the Federal Reserve, you've mentioned it. The Federal Reserve has definitely shifted to a more dovish stance after having been concerned in the fourth quarter of last year that maybe growth was slowing. The other reasons, GDP, still remains positive, especially after today's number that was released. Consumer spending is still strong, and the consumer balance sheets still look good. And as a matter of fact, they look better now than they have since really the Great Recession. So all of these are indicating anyway that a recession isn't imminent. Now it's going to happen at some point, but we just don't see it quite yet. On the international side, there's also no doubt that global growth has slowed. But there are recent signs, as Jonathan has pointed out, over the last month or so, indicating that China's potentially stabilizing. That would be good. And that could be good for Europe, as you mentioned earlier as well. Because frankly, Europe, there are some concerns there, and we still have the Brexit issue.
Now, we have shared this inversion issue last year, and actually we first talked about this back in 2017. The inversion of the yield curve, in this case, what most people look at is the 10-year Treasury relative to the 2-year Treasury. Typically, the yield would be higher on a 10-year Treasury than a 2-year Treasury because you would want a higher interest rate for that longer period where you're lending the money. But when the Federal Reserve is raising rates on the short end and we have economic concerns which bring rates down on the long end, it can actually invert at times. And so on this slide, we're showing you the 5 times in more recent decades where this has occurred. But what you should note, though, is that this is the inversion curve that most economists look at, and it has not inverted. We are still positive.
And the concern here is that when you look at the circles indicate the inversion. The gray bars indicate recessions. So typically, as you look at this, once there's an inversion, there follows a recession.
Right, but there is a lag, though.
Yes.
It can be 12 to 18 months or so. So it doesn't mean that once it inverts, you immediately go into a recession.
And we show the lags here on this chart, where back in, let's say, February 2006, the yield curve inverted, but the stock market didn't actually correct, or at least start its correction phase, until 21 months after February 2006. So as we look back, you can see there is quite a number of months typically between the inversion and the correction.
And one thing I'll mention about the inversion of the yield curve is we have, since the mid-60s, we have not had a recession in a bear market without an inversion, but we have had 2 other inversions that did not result in either a correction in the market or a recession.
So a couple false positives.
It's not a perfect indicator. It is what we think should be one of among other indicators that one looks at.
Well, and I think to your point, over the last month, and the reason we bring up this inversion discussion to start with is that over the last month, we did have an inversion. It was an inversion of the 10-year with the 3-month, not the 2-year. It was the 10-year and the 3-month. And this got a lot of press. They were talking about it in the news constantly because I think for 5 days there was an inversion of the 3-month with the 10-year. Nonetheless, if you look at the 2-year versus the 10-year, that did not invert. And as Jonathan pointed out, that's typically the one most economists look at in trying to indicate, is there a recession on the horizon?
And interestingly, when the 10-year and 3-month inverted, that was actually when the German data came out. And then when it came back up, that was actually when the Chinese data came out. So people were very, very short-term focused at that point.
So something to be cognizant of, but not too concerned about at this point. We had mentioned earlier that consumer is so important when we were talking about the consumer sentiment numbers and that they had ticked up. Well, I mentioned at that time that the consumer is so important because they really account for 2/3 of GDP. And as we're looking at here, the consumer still looks to be strong. Retail sales have really rebounded significantly off of the Great Recession numbers, income starting to tick up, and balance sheets are continuing to improve, especially the household debt service ratio, where that's fallen significantly over the last several years. So some positives there for sure. However, there are still some concerns. As we look at bonds, the Federal Reserve has shifted to a more accommodative stance. We've touched on that, and that frankly is positive as well. One thing to keep note though is that as quickly as they shifted to a more positive position or a more dovish position, I suspect the opposite could be true. And they could shift back to a more hawkish position if things look to be improving at too rapid of a pace. So we always want to be cognizant of that. But nonetheless, with bonds and with the lower interest rates, bonds should continue to do well. And I think you even put here the one thing to watch out for is credit risk, not to take too much credit risk.
Right. So right now, credit quality, that difference between higher quality and lower quality, that's actually fairly narrow. And so if growth remains strong, it could stay within that. But if we do see growth weaken, we could see that blowout in that spread, which would hurt low quality bonds.
So we're saying stay focused on higher quality credit because again, the bond part of your portfolio should be the protection component. That's helping protect from the downside of any equity risk. Which gets us to the equity discussion. Although we don't yet see a recession, and certainly one is on the horizon at some point, but we don't yet see it, valuations just frankly aren't as attractive as they had been because we had such a strong recovery in the first quarter. Now, granted, if the Federal Reserve continues to be very accommodative, that could support further price appreciation. There's a saying on Wall Street, Jonathan, I'm sure you've heard it a bazillion times, don't fight the Fed. And if the Fed continues to be very accommodative, that could bode well for the equity markets. But with such strong recent recoveries in the equity markets, it would not be a surprise to see a pullback, which means diversification and consistency of an investment strategy is more important now than probably ever. And with that comment on consistency, I want to show this table right here where we're seeing Q4 market data. We looked at this a few minutes ago. Obviously, US equity markets down double digit in that fourth quarter. Bonds were up a little bit. So I'm sure you had this, Jonathan. What were clients saying, or what was the general sentiment, maybe not even of clients, because most of our clients maybe hopefully have been educated to stomach these ups and downs, but you know, kind of general investors, they were probably saying, geez, that is so painful. Stocks are down so much and bonds are up. Maybe I should shift. And of course, if they did, which hopefully they didn't, but if they did, they would have missed out on this very, very strong recovery in the first quarter. So this just speaks to the importance of maintaining a consistent strategy, not flipping from one investment style to another investment style or from one strategy to another strategy because of these short-term performance results. And this is a great sampling of what could happen if you try to shift and you're just wrong. I'm sure everybody's seen some type of chart like this, but this is showing that if you stay fully invested over a cycle, this is 1996 to 2015, the overall market, the S&P, was up 8%. You missed 10 of those best days though, you cut your performance basically in half. And also remember, 6 of the 10 best days occurred within 2 weeks of the 10 worst days. So we've talked about in prior webinars, volatility tends to bunch. When you got big up days, many times you'll shortly thereafter, or maybe even prior, have big down days.
And we saw this in December, where we kind of accelerated into Christmas Eve, and then the following week we saw some big up days.
Yeah, very, very good point. The other thing to keep in mind is maintaining a consistent strategy over long periods, not just quarters, and over different cycles. And I think maintaining a consistent strategy is going to be especially important over the next 1 to 2 years as we enter the election cycle, which is almost certainly to be unlike any we've seen in the past. So just like when I advise, and I'm sure Jonathan, you do as well as Kathy and our other advisors, advise clients to discuss with their kids prenuptials well before they find a boyfriend or girlfriend. We want to advise you now about the dangers of allowing your personal politics to drive investment decisions. You have these discussions really before you need to have them. Just like, again, the prenuptial. Have that discussion with your son or daughter before they find that girlfriend or boyfriend, and think that you're mentioning it only because you don't like that particular boyfriend or girlfriend. So here's the discussion. We have a Venn diagram. The first circle is politics. The next circle we have is the economy. And the third is the markets. Now, there's no denying that there is some overlap between these 3 circles. However, it is also true that these circles do not completely overlap. They don't lay on top of each other. There's not 100% correlation. The point here is not to allow your politics to drive your investment or market decisions. Also, don't allow economic data that frankly is backward looking to drive your investment decisions, because the markets, particularly equity markets, are forward looking. Sure, there is some overlap, but you're not going to look at all the economic data that is always backward looking to try and make forward looking investment decisions. It's like driving using your rear view mirror in your car. It just doesn't work. So as we enter this election cycle, please, I don't care if you're left leaning, right leaning, if you're all the way to the left or all the way to the right or in the middle, don't allow your personal politics to drive investment decisions. We see it happen almost every presidential election cycle, and more times than not, those decisions that are driven off of politics just end up to be wrong, at least wrong investment decisions. So with that, let's talk about some SilverOak updates and a few important reminders as we close out today's webinar. So the updates, we are still searching for an additional associate paraplanner and another advisor to join SilverOak. So over the last many years, we've continued to grow, and that growth is continuing, where we're adding 2 new team members. We haven't yet found the perfect fits, but we are actively searching for those 2 positions. Our IQs, our investment quality scoring system, this is more on the due diligence side. The merger of one of our large cap growth positions was completed in the first quarter, so we're happy with the results there. We are in process of consolidating a couple of positions that aren't widely held across our client base. And a number of our managers have been nominated for awards at Morningstar. So those are nice accomplishments and nice kind of acknowledgments of good management teams and a good process in identifying those. But maybe even more exciting than all of that is the fact that we're celebrating our 20th anniversary of being able to serve our clients and provide them value over the years. So we want to thank all of our clients for the opportunity to work with them, to continue to work with them moving forward. It is only with them that we are successful. And of course, I want to thank the rest of SilverOak and the team members on SilverOak because we couldn't do it without having everybody involved on the team. So thank you to all of our clients and all of our team members. Important reminders: if you have an IRA that has a required minimum distribution, you need to make sure you take that by the end of the year. I know it's early this year yet, so if you haven't thought about taking the distribution, or maybe you haven't taken it at all, consider gifting that RMD to charity, at least if you're 70 and a half or older, which is the vast majority of people taking RMDs. Don't forget about your real estate taxes if you have Minnesota real property. And of course, oh, Jonathan, we can breathe a sigh of relief. Tax season is finally over. Probably one of the more condensed tax seasons we've had with all the changes in the tax law. And actually, our Director of Tax Services is putting together a small client communication that we're going to send out with some kind of points that we've learned through this tax season that we want to share with clients. So that should be coming out in the next couple of weeks. But there's a couple other reminders there that you might want to touch on.
Keep good tax records for 19 as we go through the year. Complete a tax projection. Make sure you're making required quarterly estimated tax payments. And then kind of looking at other items, consider utilizing an HSA. Very, very good deduction opportunities there. And make sure you can max out your 401k contributions. We've also talked about this, but bunching charitable contributions, as we've discussed in other webinars, is a good potential strategy under the new tax law.
Absolutely. And if any of these don't sound familiar, again, reach out to your SilverOak advisor. I'm sure we probably had discussions with you about them, but if not, or if you just don't recall those discussions, we're happy to have them again for sure. Those are important discussions to be having. And then, of course, request your annual credit report. It's the beginning of the year, a good time to take a look at those reports, and make sure that you've frozen your credit if at least you're interested, which we would highly recommend you do so. And we've listed here the websites that you would go to if you did want to freeze your credit report. So with that, we again want to remind you, if you have questions, reach out to your SilverOak advisor. If you have topics that you want to suggest for future webinars, let us know. We're happy to incorporate those. Otherwise, thank you so much for taking your time. And if you have any questions, please let us know. Have a great day.